In question 5, I think it's easiest to start with requirement 2 and prepare the journal entries. And so what we're doing in the first entry is preparing the entry to estimate bad debt expense in 2015. So this is the normal adjusting entry that we make each period, where we debit bad debt expense, credit the allowance account. And scrolling up here to look at the data for 2015, we see that 35, which is 35 million, is the amount of increase for bad debt expense. So it's the increase to the allowance account resulting from this adjusting entry. And then the second entry is where we wrote off specific accounts receivable balances. And always when we write off bad debts, we debit the allowance account and credit accounts receivable. And so we're told up here for 2015, the write-offs were 25 million. So after you prepare these journal entries, then it's easier to complete requirement 1A. And so going back here, we have our T account. Because the allowance account is a contra asset, everything about it is opposite of the rules for assets. So we increase this account with credits, therefore it's going to have a normal credit balance. And so the beginning balance, which again, we're given up here for 2015 is 90. And we have to be careful to put that on the credit side. And then because when we wrote off the bad accounts receivable, we debited the allowance account. That's why we're writing the write-offs here on the debit side and putting this label here. For bad debt expense, which we recognized in the adjusting entry, here we had a credit to the allowance account, increasing it. And so I'm writing that here on the credit side. And then Connect does this math for you. It calculates this ending balance, which you'll see agrees with the ending balance up here in the table. So then in requirement 1B, all we're doing is putting in an equation that shows how that new ending balance is calculated. Going back to the T account, what we're doing is taking the $90 beginning credit balance, adding 35 more in credit, subtracting 25 in debit, and that gives us the $100 ending credit balance. So they're having us put these amounts here into equation format. So beginning balance here, and I'm going to label this increase is from the adjusting entry where we recognize bad debt expense by debiting the account. We also credited the allowance account. And then here, this $25 amount that we're subtracting, that came from the write-offs where we debited the allowance account. And then here we have our ending balance of 100. So in requirement 3, there are 2 missing amounts. And now we're dealing, by the way, with the years 2014 and 2013. And so to figure out the missing amounts, starting with 2014, I set up this equation. I know that the beginning balance in the allowance account plus the additions, which this addition comes when we make the adjusting entry, debiting bad debt expense, crediting the allowance account. So these two added together give us this subtotal. And then when we subtract the deductions, which the deduction would be the debit to the allowance account for the write-offs, well, then we're going to get our ending balance. So in this first row, we know the figures that we see, but we don't know this amount. However, we can figure it out because 152 minus this amount equals 90. So we can, of course, just take the difference to get this number. And then for 2013, we're missing this amount, the addition charged to bad debt expense. Again, we can set up this equation, put in the numbers we have to figure out the number we don't have. And since this subtotal must be equal to the ending balance plus the deduction, once we get this subtotal, then we can figure out this middle number, or this number here. In requirement 4A, it's asking by how much would net accounts receivable have decreased if we wrote off an additional $40 of accounts receivable in 2013. Well, they don't tell us what the total accounts receivable balance was, but let's just say it was $1,000. And right now, for 2013, looking up here, we see that the ending balance in the allowance account is 102. So net accounts receivable is the difference between total accounts receivable minus the balance in the allowance account. So our net accounts receivable right now is $898. So to answer this question, if we had written off an additional 40 in accounts receivable in 2013, well, our total accounts receivable would be 40 less, or 960. Because remember, in the write-off, we credit accounts receivable to decrease it, and we debit the allowance account. Well, if we debited the allowance account for 40 more, we also would have decreased the allowance account for $40 more. It would have gone from 102 to 62. So both of these numbers would be 40 smaller, but notice that the net accounts receivable stays exactly the same. And that's why I put 0 here for my answer. And remember, I demonstrated this in class as well and pointed out how this concept, knowing this fact, that net accounts receivable stays the same, even if our write-offs increase, knowing that fact is important for a potential multiple choice question. And then finally, last question here in 4B, it's asking if we had that $40 additional write-off, by how much would income have operations decreased? And again, the answer is 0, because the writing off of an accounts receivable does not have an income statement impact. Remember, we're debiting the allowance account, crediting accounts receivable, both of which are balance sheet accounts. So no change to income from operations as a result of an additional write-off.